Students, today we are starting a very important topic in accounting called merchandising activities. This topic is crucial for understanding how retail businesses operate and make a profit. Think about a supermarket or a shop where goods are purchased and then sold to customers without any change.
That'll be $12.49.
A merchandising company is a business that buys goods and sells them directly to customers to earn profit. Now let's understand how a merchandising business operates step by step. First, the company purchases goods from suppliers, which becomes its inventory. Workers and forklifts unload the goods, preparing them for storage. This efficient process ensures inventory is ready for business needs. I'll take this.
Sure.
That'll be $53.99. Credit?
Okay, approved. Here's your receipt.
Thanks. Finally, the company collects cash from customers, completing the operating cycle. Now let's compare merchandising companies with manufacturing companies. Merchandising focuses on buying and selling finished goods, like in this retoucher involves transforming raw materials into products, as seen in this factory. Manufacturing companies produce goods, making their operating cycle longer and more complex. The production line assembles components sequentially, adding layers of core nails and finished products through intricate, multi-stage processes. In contrast, merchandising companies simply buy and sell goods, making their process simpler. I buy these products from suppliers and display them for sale. This keeps operations simple and efficient. Retailers sell goods directly to final customers in small quantities.
All right, let's get these scanned for you. One cereal scanned, soup next, and juice.
Wholesalers buy goods in bulk from manufacturers and sell to retailers. This creates a distribution chain from production to final consumer. Now let us understand the income statement of a merchandising company. The statement starts with sales, then subtracts the cost of goods sold to find the gross profit. From there, operating expenses are deducted to arrive at the net income. Sales revenue represents the total amount earned from selling goods. Cost of goods sold shows the cost of inventory that was sold. It's a key metric for understanding business profitability. Gross profit is calculated by subtracting cost of goods sold from sales. For example, if sales are $50,000 and cost is $30,000, profit is $20,000. Gross profit helps us understand how profitable sales activities are. This is a key metric on the income statement. It reveals the efficiency of our sales after accounting for costs. Accounting systems provide detailed information beyond general ledgers. For example, a detailed transaction report shows specific payments to vendors. This level of detail is essential for accurate financial analysis. Businesses to know what to expect. Businesses need to know who owes them money at any time.
Control accounts summarize total balances in the ledger.
Subsidiary ledgers provide detailed records for each customer. Now we move to inventory systems used in merchandising companies. Now, students, we move to a very important topic, which is inventory systems used in merchandising companies. There are two main types of inventory systems, the perpetual system and the periodic system, both used in practice. In the perpetual inventory system, the inventory account is updated continuously after every purchase and every sale. This provides real-time accuracy for inventory balances. The system reflects these changes instantly. Whenever a company purchases goods, the inventory account increases immediately, showing the updated stock level. When goods are sold, inventory decreases and cost of goods sold is recorded at the same time. This system provides very accurate and up-to-date information about inventory and helps in better decision-making.
Let us understand this with a simple example so that the concept becomes very clear to all of you. See here, 2 plus 3 equals 5 and 5 plus 4 equals 9.
Suppose a company purchases 100 units at a cost of $30 per unit from a supplier. The total cost of this purchase becomes $3,000, which is recorded in the inventory account. Now suppose the company sells 10 units to a customer at a selling price of $50 per unit. The sales revenue from this transaction becomes $500, which is recorded as income. At the same time, the cost of goods sold for these 10 units is calculated as $300. So in the perpetual system, every sale requires two entries, one for revenue and one for cost. This dual entry system ensures that both profit and inventory are correctly recorded at the same time. Now let us move to the periodic inventory system, which is simpler but works differently. This diagram shows how it tracks inventory and cost of goods sold. In the periodic system, inventory is not updated after each transaction during the accounting period. Instead, updates occur at the end of the period, contrasting with the perpetual system, which updates in real time. Instead, the company waits until the end of a period to calculate the value of inventory.
No cost of goods sold entry is recorded during the period under this system.
At the end, cost of goods sold is calculated using a specific formula based on inventory values. The formula is COGS equals beginning inventory plus purchases minus ending inventory. The formula is beginning inventory plus purchases minus ending inventory, which gives cost of goods sold.
This method is easier to maintain but does not provide real-time information like the perpetual system.
To ensure accuracy, businesses perform physical inventory counts at the end of the period. Verifying stock levels now. This process reconciles records with actual stock on hand. Shelf count matches. Sometimes there is a difference between recorded inventory and actual inventory, which is called shrinkage.
Shrinkage may occur due to theft, damage, spoilage, or errors in recording transactions.
Now we will move forward and understand credit terms and cash discounts in detail. Credit terms, like 210 net 30, define payments and disopportunities, improving cash flow for both parties. Now students, let us understand credit terms, which are very important in merchandising transactions.
For example, 2/10, net 30 means a discount is available within 10 days.
If payment is made within 10 days, the buyer gets a 2% discount on the total amount.
If payment is not made within 10 days, then the full amount must be paid within 30 days. These credit terms help businesses manage cash flow and encourage early payments from customers. Now we will study how purchases are recorded using the net method in accounting. Under the net method, purchases are recorded at their discounted value, assuming payment will be made early. For example, if the purchase is $4,000, the recorded amount becomes $3,920. If payment is made within the discount period, no additional expense is recorded in this method. If payment is made late, the discount lost is recorded as an expense called purchase discounts lost. Now let us understand the gross method, which is another way of recording purchases.
Under the gross method, purchases are recorded at their full invoice value without any discount.
If payment is made within the discount period, the discount is recorded separately at that time. This discount reduces the cost of goods sold and increases overall profit. If payment is not made within the discount period, no discount is recorded under the gross method. Now we move to returns of unsatisfactory merchandise, which are common in business transactions. Hi, I'd like to return this.
Of course. What's the issue?
Okay, let me check. Sometimes businesses return goods to suppliers if they are damaged or do not meet required standards. We inspect the item and process the return. It goes back to the supplier. These returns reduce the purchase amount and are recorded as purchase returns. For example, if $500 of goods are returned, the payable amount decreases accordingly. Now let us understand transportation costs related to purchases. Transportation costs are the costs incurred to bring goods from the supplier to the business location. These costs are considered part of the inventory cost and are added to the purchase value. Now we shift our focus from purchases to sales transactions in merchandising companies. Hi, I'll take this.
Okay, that will be $49.99.
Here's $50 in cash. Thank you, and here's your receipt. In the Perpetual system, each sale requires recording both revenue and cost of goods sold. For example, if goods are sold for $2,000, that amount is recorded as sales revenue. At the same time, the cost of those goods is recorded as cost of goods sold. This ensures that profit from each transaction is properly calculated and reported. Now we will discuss sales returns and allowances, which reduce total sales revenue. If customers return goods, the company records a reduction in revenue through a contra revenue account.
These accounts help in showing the true net sales figure after adjusting returns and allowances.
Similarly, sales discounts are given to customers who pay early within the discount period. These discounts are also recorded as contra revenue because they reduce total sales revenue. If payment is not made early, then no discount is allowed, and full revenue is recorded.
Now let us understand delivery expenses incurred by sellers during the distribution of goods.
Delivery expenses are treated as operating expenses and recorded separately in the income statement. These expenses reduce the overall net income of the business after calculating gross profit. Another important concept is sales tax, which businesses collect on behalf of the government. For example, if a sale is $1,000 and tax is 7%, $70 is collected as tax. This tax is not revenue for the business and must be paid to the government later. Now we will briefly discuss how accounting systems can be modified for efficiency. By streamlining data flows and optimizing workflows, we can significantly improve performance. Most businesses use special journals to record frequent transactions instead of using a general journal. This helps in saving time and organizing accounting records more efficiently in daily operations. Finally, we move towards financial analysis, which helps evaluate business performance. One important measure is net sales, which is calculated after deducting returns and discounts from total sales. Gross profit margin is another key indicator that shows the percentage of profit earned from sales. It is calculated by dividing gross profit by net sales and helps in comparing performance over time.
Businesses also analyze trends, store performance, and sales per area to improve efficiency.
These analyses help management make better strategic decisions for growth and profitability. This data-driven approach ensures we maximize our profitability. Our team can now plan for sustainable growth. In the next part, we will conclude the chapter with a quick recap and important exam questions.
A merchandising company is a business that buys goods and sells them directly to customers to earn profit.
The operating cycle includes purchasing inventory, selling goods, and finally collecting cash from customers.
Cost of goods sold represents the cost of inventory that has been sold during the period.
Gross profit is calculated by subtracting cost of goods sold from total sales revenue. For example, $10,000 in sales minus $6,000 in costs equals $4,000 in gross profit.
There are two inventory systems: Perpetual, which updates continuously, and Periodic, which updates at the end.
Credit terms like 2/10 net 30 encourage early payments and improve business cash flow. Purchase and sales discounts reduce costs and revenues and are important for accurate financial reporting. Returns of goods reduce purchases or sales and must be properly recorded in accounting records. Returns of goods reduce purchases or sales and must be properly recorded in accounting records. Sales tax is collected from customers and later paid to the government, so it is not business revenue. Question 1. What is cost of goods sold? Is it revenue, expense, asset, or liability? The correct answer is expense, because it represents the cost of inventory that has been sold. An expense on the income statement reduces net income, reflecting the consumption of resources.
Question 2. Which inventory system updates inventory continuously, Perpetual or Periodic?
The correct answer is Perpetual Inventory System, because it updates records after every transaction.
Question 3. Gross profit is calculated as sales minus what? Inventory, cost of goods sold, or expenses? The correct answer is cost of goods sold, because it represents the direct cost of goods sold.
Question 4. Which account reduces sales revenue, returns, assets, or liabilities? The correct answer is sales returns, because it is a contra-revenue account.
Question 5. What does 2/10 net 30 mean in credit terms? This means you get a 2% discount if you pay within 10 days. Otherwise, the full amount is due in 30 days. It means a 2% discount is available if payment is made within 10 days. The terms are 2/10 net 30. This 2% saving can add up to significant amounts over time.